Good morning, traders. It is Wednesday, April 3rd. My name is Charles, and this is the Pirate Traders live stream. Welcome one, welcome all. Appreciate y'all joining. If you can, smash that thumbs up button. I sure would appreciate it. Those likes help to spread the word that we are live streaming and people should join. All right, let's talk about the scenarios for today. Now, you guys are going to be mad at me because I'm literally going to lay out a scenario for the market to go up, down, or sideways, as I do believe that all three, could play out today. But what I'm going to do is I'm going to give you an understanding of what you would see that would tell you which of those is happening. Okay? So first things first, there is a very real probability that the market might just go sideways inside yesterday's range. Okay? We had a big move with a lot of excess yesterday with the gap down. Once that move was exhausted, which happened right away, I mean, they literally only extended into the first hour of the day, the market basically just went sideways from there. The market then just went sideways all night. So it would not be unreasonable for me to watch the market just go sideways all day again today. So what would tell me that that is not happening? Well, first thing would be if the market can get above yesterday's high, then we are almost certainly looking for continuation to the upside. So if the market looks above yesterday's high and finds any new buying up there, we should be bullish. But if it looks above yesterday's high like it did in the overnight and it just fails and comes back in, we should expect more of what happened in the overnight. We should expect the market to just continue to go sideways. All right, market is open. Now, the same exact thing is true of the previous day's low. Okay, I would even say if you wanted to be a little more conservative with it, you could use this node right here around 52.38. If the market pushes down there and it just looks below that level and reverses back up, well then more sideways, more chop, more balance inside yesterday's range. However, if they repair these weak references and then they get new selling, I would be bearish for continuation lower. So that is pretty much the scenarios this morning. Market gets above yesterday's high and finds support. I am bullish. Market gets below this node at 38 and finds resistance. I am bearish. Anything in between. The assumption is the market is going to continue to just rotate and chop and go sideways inside yesterday's range. So now let's just take a second to understand the context of this on a longer time frame. We'll zoom out and take a look at it on the daily time frame. Okay. Yesterday we've had this channel that we've been monitoring for a while here on the ES. Okay. Yesterday we looked below that channel. That was bearish to see because it might mean the market was looking to break lower. But at the very end of the day, we pulled back in and we actually closed back inside the channel. So that meant anything could happen. The next day, the market could continue lower, or we might get a look below and fail that sends us up towards the opposite end of the channel. So I could see a scenario where today's market looks a lot like this day here. So imagine this was yesterday. The market gets a little bit of momentum to the downside. It turns around and starts heading back up. That could slingshot the market right back up to the opposite end of balance. This is a very common thing. The market finds support and it slingshots up. It finds support and it slingshots right up. Okay? Now that doesn't necessarily mean today intraday. I'm talking about over the next few days. But if the market is able to get above those overnight highs and find new buyers, that is the highest probability in my mind that the market is heading up towards the opposite end of balance around 53.10. So what would we be looking for if that were to take place? If the market were to get above yesterday's high? Well, the first thing would be to test the balance area low at 52.74. So market pushes above the high, it finds support, it gets up there. Does it get resistance at 52.74? If it gets smacked down there, very bearish to see. Okay? But if it passes back up into there, we are almost certainly going to fill the gap from yesterday up to 52 82. And quite frankly, I wouldn't even really be looking for resistance there, because if we get back in that previous balance area, not only have we had a look below and fail of the channel, but also of the balance area. So this is the balance area right here. Actually, let me just zoom in a bit. Okay, this is the balance area right here. So a look below and fail of the channel increases the odds that over the days and weeks ahead, the market is moving to the opposite end of the channel. And a look below and fail of the balance area increases the odds that we're heading to the balance area high. So if that were to happen, if we were to get back up into that previous balance area, it would be extremely bullish to me, as there would be a lot of sellers that would be getting squeezed, and just boop, 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 the market can start to make a move. Okay? So that level, this area around 52.74 is going to be very, very important. If the bulls can get up there, can they burst through it? Can they get through? If they can, to the moon. If not, to the downside. Okay? Now, if the market today either rotates sideways inside yesterday's range and closes below that channel low, right? Closes somewhere where it is right now, or it continues lower today, right? They get down there, they get new selling, and they get continuation lower. That is extremely bearish to see and sets us up for a larger move. Again, not necessarily intraday today, but in the days and weeks ahead, that sets us up for a larger pullback because we are failing to find support on this channel. So that means we've had too much momentum on a weekly time frame, and we need to pull back on a weekly time frame. So let's just zoom out and take a look at the weekly candles and see if we can't find some levels that would be of interest. Yeah, so the first potential support on a weekly time frame is going to be around 50.55, then around 49.38, and then finally at previous all-time highs around 47.92. So this channel breaking could lead to a massive pullback. There is potential for a very big move, again, over the weeks ahead, a very big move to the downside. So today should be a very interesting day, whether it goes up, down, or sideways, because it will give us an indication of what to expect in the weeks ahead. Okay? Obviously, the least exciting market for intraday traders would be a sideways choppy market. And of course, that is what we're getting right now. So let's sit back, relax, and enjoy the chop inside yesterday's range. If I had to pick whether I think it's going to go up, down, or sideways, right now my choice would be sideways. I would have said bullish if we'd have opened up inside the spike up from yesterday. I even would have said bullish if they could have held the 45-degree angle in the overnight. But that little bit of selling right there and that failure to stay up inside the spike up tells me the odds are higher that we're just going to go sideways for a bit. Let's see what happens. Once again, please hit that thumbs up button. I really would appreciate it. We're on the public YouTube right now. So the more thumbs up that you give, the more new, people on YouTube, the algorithm will show this to. And we always love having new friends to join the community. Also, feel free to share on Twitter or Facebook or any of those social platforms that you love so much. We'll be hanging out here together for a few hours. Why not? Another reason to assume chop this morning is the fact that we just created a weak low on the A period low. It is weak because it was a weak reference yesterday, a very weak reference. Okay. And not only did they reverse one TPO below that reference, making it weak, but they also only traded 2 contracts down there. So that tells us there is liquidity waiting, and the market will likely come back for that at some point here today. We are pushing up into resistance around 52.59. I would look for the sellers to step in and try to take the market lower from there. It's a chop zone. It's a chop zone. All right, let's take a look at the NQ and see what's happening with Zetec. Oh, same story. So yesterday in the Brigade live stream, we talked about the importance of the cumulative nodes on the tick. That is the large nodes over a longer time frame that are created using volume profile. You can see that as the orange over here on the left side of the screen. This market loves to move from one big node to the next and back and forth again and again. So it'll move from this one to this one, come back down, move to this one, go up to that one, come back down. So again, same story here. The same way we talked about the trend lines and the channels on the ES, which direction we break away from this large node that we're dancing on right now, around 18,290, whichever way we break, we are likely to get a big move. If the market breaks higher, it is likely to move back up towards the 550s. If the market goes lower, it is likely to head down towards the, we'll call it 1800s. So same thing as the ES, looking for chop, looking for sideways grind today. But depending on which way it breaks, we are looking for follow through. As far as the chop zone is concerned, on the NQ, if you want sort of a tighter range, you could basically look at something like this. Okay, so between like 18,230 and 18,310, that is where there is a large cumulative node from yesterday to act as support, also the overnight low, and a large time and volume node up here from the overnight. So if you're looking for a tighter chop zone to trade, that would be the one. If not, it would be all of yesterday's range. So you would be looking for the market to get below yesterday's low and get new selling before you'd get bearish. Otherwise, you'd assume a look below and fail that will just chop some more. Or you'd wait to get above yesterday's high and find support to get bullish. Or you just assume more chop. Because it's a chop zone. Do, 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 do. Good morning, good morning, good morning to Cool Beans. Welcome. Jay is in the house. Good morning to you. He says, bells and whistles going off at the casino. Action equals opportunity. 100%. That is all we do as traders, is we sit and we watch the market-generated information and we look for opportunities. What are opportunities? Opportunities are places where we believe we have an edge in understanding what the market is going to do, and we can enter trades where we're taking way less risk than our potential reward. If we get both of those things, if we get a good understanding of what's happening, of what the market is likely to do next, and an opportunity to enter a trade where we can risk way less than we can win if we're right, well, that, my friend, is a market-generated opportunity, and that is what we want. He says, nice website, the 3 M's, mastery of markets and mind. I know, I love things like that. Besides, M&M was already taken, so I had to add that third M. Tony says, today is going to be wild. Well, I don't know. I think however today closes will set us up for something wild, but we may just have a sideways day. Let's wait and see. Good morning to Will. Ships is here. He says, hello from Spain. Hola. Scalp Demon in the house. Cool Bean says, today's stream is pubby? Yeah, we're public. Feel free to tell your friends on Reddit. Grizzly Bull in the house. Pavel is here. Philip, good morning to you. Jay says, Fed heads all day long. Next one's at 9:45. Oh, say it isn't so. Well, it's just more fodder for volatility. Pal at noon. Is he speaking publicly? Can we watch? Bust a move in the house. Percy is here. He says, greeting, amigos. Pirates. My Spanish is excellent. It's very good. Danny, good morning to you. Will T in the house. Tim is here. Juan, good morning. Bri, good to see you. Malang is here. 200 dogs. Pavel, Sebastian, Jerry, Kazhal, good morning to you. He says, I would like to learn from you. Do you have any course? Absolutely. If you look at the top of the chat, you'll see the link to marketsandmind.com. I got a workshop coming up next month. We'd love to have you there. That workshop is all encompassing. I don't just teach you how to read a chart. You know, when I first started in this business, I falsely thought to be successful as a professional day trader, all I had to do was learn to read a chart. All I needed to do was find some setups that were profitable that I could trade again and again. But what I have come to understand, both from my own experience and from trying to help others learn how to do this for years, is that there is way more that goes into consistently being able to make money in the markets again and again. Sure, you need to learn to read a chart. Sure, you need to find some setups to trade. But ultimately, it is about how you manage your mind. It is about how you handle your emotions, how you handle drawdowns, how you handle difficult markets. There are just some times when the market is easy to read and easy to trade, and sometimes when it's difficult. And you have to be able to survive those tough patches and able to be able to do this consistently, for years and years. So that is what the course is all about. Teaching you not just how to read a chart, which I will absolutely do, not just showing you setups, which I absolutely will, but really to teach you how to think like a trader, how to operate like a trader, how to conduct yourself so that you can stay in the game for the long run. Marketsandmind.com. Holding a Fart says, I highly recommend his course. Well, any recommendation from Holding a Fart is one that should be considered by all. RK says, with Future Trader 71 quitting on 4/15, maybe start a 9 a.m. and grab that audience. Well, he's not going to do those live streams anymore? Oh, that sucks. I mean, I haven't watched one in years, but I used to love them. Good morning to Frito. Debbie B in the house. Good morning to you. Frito says Future Trader 71 picked him up at his house and took him out for pizza. Shit, do I have to start doing that? Do I have to start picking you guys up, taking you out for pizza? No, that's pretty cool. Bernie in the house. Good morning to you. Mark from the UK. Welcome, welcome. Paper Demo Guru. Good morning to you. Vu is here. Willie T says, I'm in the new course. If I can't cover the cost of the class in 2 weeks, I'm going to find something else to do. That's fair. I'll take it. I'll take that. You know, when I was learning, I spent so much money taking courses with different people, a lot of them that turned out to be a waste of time. And even Jim Dalton, you know, who I would say is my main mentor that I learned the most from, I had to keep retaking his course before it like really sunk in. I probably spent at least $4 or $5 grand on classes just with Jim Dalton. Did I get that $4 or $5 grand back in the next 2 weeks? Of course not. But now, years later, having taken that knowledge, made it my own, put it to work again and again, I mean, tenfold, I've made that money back. So that's the way it works with education. You take away from it what you can. You know, you pay $300 and then maybe one single idea works out for one single trade on the ES and you make $300 right then and there. But then you can still use that knowledge the next day and the next day and the next day and the next day. Good morning, Jads. Alyssa is here. She says, I agree. The course is excellent. Danny, I'm not sure what you're saying with yes, please, but okay. Tony says, I'll buy you pizza if you are in Austin. I'll take you up on that. Rocky, if you pick me up, I'm not sitting next to the holding a fart dude. Well, he holds them, though. That's his whole thing. What do you got to worry about? Malang says, please do not change the start time for these sessions, people on the West Coast. It would be too early. That is fair. It is like 6:30 a.m. right now. Chirag says, I have taken the course. You will cover the cost of the class while you are in the class. Second half of the live market will give you a great insight. Yeah, the first part of the day is always a lesson, you know, like a PowerPoint presentation, traditional college course type of lesson. And then the second half of the day, we talk about live markets. And I do mention trades if I see them. Percy, thank you very much. Rocky. Well, one speed bump and the car is now holding a fart. Oh, that's good. Percy says, I used to constantly sell the low and buy the high. Yeah, we want you to do the inverse of that. You must buy fear and sell greed. Okay? When you feel like you should be getting long because, oh my God, I'm going to miss it. It's so easy to make money. Look, we're breaking out. That's probably the best time to actually be going short, and vice versa. You got to buy support when it feels scary, not when it feels easy. Because if it feels easy, you're probably too late. You're probably a laggard. Buy fear and sell greed. Danny says, Charles, I can't make all 4 hours in the workshop. Does that matter? No, it does not. All the lessons are recorded, so you can go back and watch them at the end of the day or, weeks, months later if you want and catch up. Also, each lesson is self-contained. So if you miss like a Tuesday, you can still show up on Wednesday and you won't have missed anything. Nando says Dell is making a move up. Man, I haven't looked at Dell probably ever. Wow, look at that. Yeah, I would agree with you. It looks like it's heading up to test the all-time highs around 130. Now, the question is, what will happen when it gets there, right? Will we just double top and then fail much lower, or can they keep the momentum going? But I would say as of now, it does look like they want to test that high once again. Oh, also, we should talk about the Bitcoin. Bitcoin. Oh, wait, I was on the wiki. Let me go back to Dell again. Sorry, guys. I didn't realize I was on the weekly chart. Let me go to the daily. Yeah, same story. They've got momentum. Massive gap up. I assume they said something about AI. An attempt to fill the gap. Balance. Broke higher. Balance. Broke higher. And now we're getting excess. So yeah, I would say, I mean, obviously not today, but in the days and weeks ahead, they're heading to 130. All right, now let's look at the Bitcoin. Yeah, so I got this trend line that I drew on the Bitcoin from the lows around January 23rd. Okay. And the way I see it, obviously, Bitcoin is balancing on a longer time frame. So the highest probability is it will continue down towards the balance area low. We could call that, 63,000. And then if it gets a look below and fail, it could turn around and head right back up. But to me, if I really, truly wanted to get bullish longer term on Bitcoin, I would need to see it get back up towards the all-time highs. I would need to see it at least get above this trend line. Okay? Because what in my mind is probably more likely at this point is that this will be a dead cat bounce. It'll come back up and test that and then turn that what was support into resistance for a larger pullback. So I would be cautious on the corn if you're a longer term investor. Now, if they get back above that trend line, let's say they get to like 71 or even just 70,000. Well, then, we're going back up to all-time highs and we can get bullish once again. But there's a very real chance they turn this support into resistance, which would lead to a pullback. Maybe even as far as like 54,000 or 50,000. So caution on the corn. All right, back to the ES and the chop. Okay, so we got some resistance that is holding up here at the high. We have good taper. So the next thing that we're watching is the halfback right here at 52.52. If it's also the VWAP, it looks like. If that holds as support, if they bounce and bounce and bounce and they hold support, we assume they're heading back up for the high. If not, coming back down through the opening price for the week low. Watching the halfback and monitoring the chop. Also, it looks like Bookmap has just gone dark, which means at 10 a.m. there must be some news coming out. So we'll look for a little volatility and see how that plays out. Joe says, course is great. Best part is I have rewatched selected parts several times. That's the upside to having the video. Well, there's your volatility. Man, some one trader just got taken out for 200 stops. Sorry, 600 stops. Okay, so now we are back at yesterday's high. Can they turn it into support? We should not be bullish yet. First off, this is just the low liquidity because of the news, and they have to turn this into support. Otherwise, they will come right back down, and the chop will continue. So don't FOMO into a long just because the market moved very fast. Wait for the liquidity to re-enter the market and the previous day's high to turn into support. Man, somebody was very short the market and they just got wiped out. Oh, man. 797 contracts. Okay, we're starting to get some day trading bots re-entering the market. Liquidity is starting to come back. You can see what it looked like over here. It went dark. Now that color is coming back. So now we're looking to see, can they turn 52.62 into support? If they can, I will be bullish for continuation to the upside. Charles, don't you just want to go long, though? Look at how far it's going and how fast. No, sir. This is short covering. And it can end at any moment. we are also right now about to test that balance area low, which has a very high probability of smacking the market right back down. So we must wait for the market to pull back and create support. Bookmap says they'll find it. The liquidity is stepping in. So the banner at the bottom of the screen says that the market is in a chop zone, but Charles is feeling bullish. And you're saying to yourself, wait a second, didn't we just break out of that chop zone? Not until we pull back and turn it into support, because it could easily look above and fail and go right back through the opening price. So we are still assuming, even though I now believe we are going to head up and test that balance area low, we are assuming we have to see that support first before we can trust the momentum. All right, new buying at the high. That is FOMO buying. So you got short covering followed by FOMO buying. That is bullish to see. The question now is, how does the market handle the resistance? Just above price. We got resistance here at 74 and then above at 78. The fact that we got new buying up at the high increases the odds in my mind that the previous day's high will hold as support when we come back to test it. Charles, that doesn't make any sense. You get bullish up here, but you wait for the market to pull back? How can you be bullish? Bullish is having understanding of what the market is doing. The next thing I need is an opportunity to get into a trade where I am risking way less than my potential reward. If I'm looking for support in here and looking for it to stay above the previous day's high, there is a much better opportunity getting long in here than trying to FOMO in at the high. But that doesn't mean I have to ignore the information at the high that we are getting new buyers. That's telling me there's some momentum. And now I just need to see some support. We know we got FOMO buyers. Do we have strong hand buyers ready to step in at support? All right, first potential support right here, 65 was the first little note of buying. The first, large set of stops that got took out. If we don't bounce here, we will look for support at 62. No support yet. Look at them ticks. Okay, ticks are saying no support here. So we likely need a little more of a pullback to bring in those new buyers. And so begins the bot shenanigans. All right, we have an iceberg below and an iceberg above, increasing the odds. We're going to spend some more time bouncing around up here. As long as this iceberg remains at 52.73, it is acting as a magnet. So the further they push away, the more likely they are to come back. Okay, back to test this iceberg. Can they break through? Or does it continue to hold as resistance? Here at 73. They're through. More short covering. Okay, next resistance above is at 77. It is bullish to see that we are back up in the previous bounce area, but this move has been very, very fast. So I still think they need that larger pullback to give those stronger hands a chance to step in. Smacking down at 77 would likely do that. Okay, so there's a chance they turn 71 right here into support, but it is less likely in my mind. But I'm watching it right now for a potential bounce. Okay, more FOMO buying at the high. So the more time And the more volume they start to bring in above 74, they are back inside that previous balance area. This is what we talked about this morning when we looked at the daily chart. A look below and fail of the channel increases the odds. Again, not today, but in the days and weeks ahead, we'd be heading up towards the opposite end of the channel, right? And a look below and fail of the balance area would increase the odds we're heading up towards the opposite end of balance. So the more time and the more volume that we bring in up here, FOMO or not, the more people that have been shorting that are going to be forced to cover, the more buyers you're going to bring in. People are going to have to start chasing price. So things could get very interesting if they can stay up here above 74. Tony says, "Are you not entertained?" Great movie. Ronald says, the Russell and the Q fell back into yesterday's range. Let's take a look at the Q. No, sir. It looks like they turned that into support, the previous day's high. And they are now getting follow through. So the Q clearly going for the gap fill at 18,414. Will they get resistance there? Again, very bullish scenario for the NQ. What did we talk about earlier today? That the way we broke away from this large cumulative node would likely lead us to the next large cumulative node. We just broke away to the upside. So that increases the odds. In the days ahead, we're heading back up towards 18,550. Bullish to see. Can they keep the momentum going? Both markets. Boy, these icebergs are working hard to stop the market from spending time in that balance area. Someone else just got taken out for 484. And now they're instantly trying to stop it again. So you could see they were trying to short the market right here to stop it from going higher. And then when it broke through, they got stopped out, and now they're doing it again. They desperately do not want the market to spend time and bring in volume above 74. Danny says, could the whales be accumulating at these levels? Yes, that is possible, right? This is the back test of the balance area low. So technically, it could be possible. All these icebergs are a larger player getting short here. But this is the problem. What you just saw just now. The argument against that would be these 400 contracts getting stopped out. So they were getting short with size, but then they instantly got stopped out. So they're not really trying to accumulate if they're going to let themselves get stopped out, with just a point of a move, right? So more likely they're trying to reverse the market right here intraday just for the moment rather than accumulating a larger position. But of course you never know. You never ever know. Someone's doing something. That's all you know. Okay, so once again, a little resistance here at 77. If they get through that, they are looking for the gap fill up to 82. If the market does get smacked down, it should need a larger pullback this time. FOMO buyers stepped in here. They stepped in here. And if they don't get anything for it, they're likely going to need a larger pullback to bring in those stronger hands. So let's see how the market handles this resistance. Okay. So as we print the C period, we have left behind a very large set of single prints in the B period. That increases the odds that at some point today, the market will pull back to backfill those single prints. But at the same time, what are we doing right now? We are spending time and we are bringing in volume back inside the previous balance. So that increases my odds. It increases the odds in my mind that they're going to fill that gap up to 82. And we will be looking for resistance there. Watching these ticks. If they stay below 0, we need to pull back down and fill some of these single prints. If they get back above, we'll push right through the resistance and continue higher. What's it going to be, ticks? What's it going to be? Okay, we got the ticks. Still got this poor high. One more TPO. Come on, market. You can do it. Jay says NQ is there. Did they fill the gap? Phew, they did. That's a gap fill on the Q. So I suspect the NQ will need to pull back. I mean, look at how many single prints they left behind. The NQ will now probably need to pull back and backfill some of this. There will have been sellers waiting inside yesterday's range. So those sellers should at least be able to backfill some of the singles. I would say it remains bullish anywhere it finds support above 18,350. Anything above that is bullish for continuation higher on the Q. Okay, so we got a poor high, which increases the odds the market needs to push away, looking for more buyers. And the ticks are back below the 0 line. So I would say this C period low, 74, that is the deal or no deal level for the buyers. If these FOMO buyers want to keep this momentum going, they've got to hold this low and break that poor high. If they do, no problem to get a gap fill. But if they start to pull back down into the single prints, all the FOMO buyers who've been buying up here will get squeezed and we'll get a bit of a pullback. Can they hold it? Ticks are saying yes. LKE says, what platform are you using on the left? That is a market profile chart, also known as a TPO chart. And the software is a company called Window Trader. Window spelled without a W at the end. There is a link in the description if you're interested. But any market profile software is fine. You can just Google, the name of your broker and market profile and see if they have it. Percy says, yeehaw! Okay, doesn't look like they have the buyers to repair the poor high yet, so we're looking for a pullback. It's hard to call the exact support where it will bounce. Could be 70. although more likely in my mind, we're pulling back down towards 65 or 62. So we gave the FOMO buyers a chance. They bought in here. They got to move higher. They bought in here. They got to move higher. They bought a lot up here, but they didn't get a move higher. So that tells us that any of these buyers who've been buying up here above 74 are likely to have their stops just sitting right in here. And as the market pulls back, they'll take out those stops. So now it is time for the stronger hands to step in. Nope, bounce the ticks again. More FOMO buyers. Jesus. So the more they buy right here, okay, where price currently is sitting, and they don't get through that poor high, the more likely they're setting up for a liquidation. Because these are short-term traders that get squeezed very, very easily right now. It's liquidation time. Come on, y'all. It's liquidation time. Truman says, buy fear and sell greed is my new mantra. Dude, just do that in your own personal trading, and you will see an enormous improvement on your returns. Are my TPOs in 5 minutes, 15 minutes, or 30? Thank you, Pavel. They are in 30-minute increments. So each letter that you see on the screen represents a 30-minute time period. You've got the same profile side by side here. This profile here. And this profile here. And the reason that I have them both here is because the one on the left is collapsed. So it will, I mean, obviously we're only in the first hour and a half of the day, but it will look like this, where all the letters overlap one another. Whereas this one will be more like candlesticks. Each letter will be on its own, side by side. And the reason that I look at both at the same time, the side by side ones, much like a candlestick, just let me see how the momentum is moving throughout the day. And the collapsed ones let me see where the market spent the most time. You know, the more letters, the more time. And that is often areas where the market will turn things into support or resistance. For example, if you look at the B period low, this morning, the market opened down here, created a weak low. It turned around, it went back up, and then it was just grinding and grinding and grinding and grinding right up here, which is why we have this big volume node right here. Well, what were they grinding on top of? the the time point of control from the overnight. That level where they spent the most time, that's what they turned into support. The news comes out, boom. Short covering, boop, boop, boom. FOMO buying, boop, boop, boom. More FOMO buying, boop, boop, boom. More FOMO buying, and more FOMO buying, and more FOMO buying, and more FOMO buying. And that's where we're at now. So where do I think, whenever the market does get the larger pullback, where do I think it's going to happen? Well, probably where these TPOs are, right here, where they spent time yesterday and in the overnight. So I just want you guys to take a moment to think about the participants. Who buys at the high? Who watches the market make a, 20-point move and then goes long at the high of the 20-point move? What kind of traders do that? Less experienced, weaker hand traders. What do those traders want the market to do if they're going long up here? They want it to go up. They want to go fill that gap. They're desperate for that gap fill. So if they were buying in here, and 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 they don't get that gap fill, what are they all fixing to do? Get squeezed. So I know I said it earlier, but I'm saying it again. They have got to hold this support and break through this poor high, or this thing's coming back down. It's only a matter of time. Each time they pull back, there's fewer and fewer people willing to go long. You could see earlier, people willing to go long, willing to go long, willing to go long. Oh, not as many. Got to pull back a little bit more. Not as many. Got to pull back a little bit more. Not as many. Got to pull back a little bit more. So they really need to break through this poor high. Right here, right now, to keep this momentum going. Or there may not be any FOMO buyers waiting on the next test of support. Dun dun. Dun dun. Still getting nothing for it. Ooh, they're starting to panic. JWF says, is 5266 a good area for a long, or are you looking for deeper? That may be the only opportunity you get. On a pullback, that might be all you get is 66.25. So if you're looking to get long, and again, I'm not telling you how to trade, but you might want to at least put on a very small partial position there so that you're at least in the trade. But I do suspect we're going to test yesterday's high at 61. It's just hard to know when there's this much FOMO. You know what I mean? You got people who were shorting over the last few days. They're panicking out of their shorts. They're covering their shorts. And you got new FOMO buyers that feel like they missed this big 20-point move and they got to get long. And so it's a little bit tricky to nail exact reversals in this market. Sometimes you got to take on a little extra risk just to play the game. Cool Bean says, does the overnight count as a 45-degree angle? Technically, no, because of that K period, because just literally a few minutes before the market opens, they broke it. But obviously, it did work as a 45-degree angle. It held as support. In particular, the fact that they left behind such a weak low. You have to understand, this low is crazy weak. Like very, very weak. And if it hadn't have been for the momentum created from that news drop, they almost certainly would have come back for it. So I wouldn't overthink the 45-degree angle today. I would just say, listen, that news dump created a change in the market. They squeezed some massive seller. You know, hundreds and hundreds of stops were taken out, and that brought in FOMO buying. And so now we have momentum, and we just got to see how long can they keep that momentum going. And there you have it, folks. They are now one time framing. The FOMO buyers win, increasing the odds they're going to get that gap fill. Woo! So you say to me, Charles, you told me there was going to be a liquidation. Why is there no liquidation? Well, they were able to spend enough time and bring in enough volume to break that poor high. So the buyers remain in control. They still have the momentum, which means there are more shorts to be squeezed. And now the next test of 74 will likely hold a support because there will be buyers now. They finally saw it work. So if there's any FOMO left, they'll be there. There you go. Another 300 contracts taken out. Squeezing those sellers. Scooball says this 5280 order wall can be resistance too. Absolutely, but I have a feeling it's going to spoof. I have a feeling it's going to disappear. It seems more like they wanted it to be a magnet to pull price to it, more so than they want it to be resistance. And the reason that I say that is because if you look at the change in color, the differentiation in color, you will see that it is getting darker and darker and darker throughout this whole time that we've just been grinding around above 74. And so it's like each attempt that they start to pull back, it gets darker, and it starts to pull back and it gets darker. So I think they're more trying to turn that into a magnet to bring price to it, more so than have it be resistance. So I suspect it will spoof. About one tick before we touch it, it'll just poof, disappear. Okay, so printing the D period changes the entire scenario for the market. Bigger picture, there is one of two questions that we are asking ourselves. We're talking about this previous balance area over here, okay? And we're saying, is today's market going to test that balance area and get rejected and continue lower? Or are we going to spend enough time and bring in enough volume to head up to the opposite end? Well, now the intraday trend is giving us an opportunity to find out. If they want to keep this momentum going, they have to keep the market above 72, which is the end of the trend, what we call cessation of the trend, in order to keep this momentum going. At this point, if the market pulls back down below that C period low, that will probably be it for the momentum for the day, and we'll just go sideways the rest of the day. Okay? So they've got a poor high. This is just a push away, looking for support to come back and continue to fill that gap. This is absolutely still bullish, but they must hold that C period low. Let's see what happens. What are we noticing about the tempo of the market? Things slowed down quite a bit in the C period. Very small range compared to the A and B period. So this is the same thing. I know I just keep repeating the same thing over and over, but you got to understand the context of what's happening. This is FOMO buying. This is short-term traders. All they want to do is fill that gap. So they've got to do it now. They've got to do it in the D period. They got to keep this momentum going, or there just won't be enough of these short-term traders to keep the market up here. Can they hold that C period low? Abu says, what about the NQ? Same thing. One time framing higher, back inside yesterday's range, bullish to see. They got to hold the C period low, so they got to stay above 18,398 to keep the momentum going. But no reason they can't. No reason at all. And look what disappeared at 52.80. Those sons of guns. As soon as we almost poked it, they just disappeared it. Which tool am I using for volume profile? It's the market profile software. So this is the volume profile here for the day's range. And this is the volume profile here for the current 30-minute time period. And of course, that is Window Trader. Link in the description. Any questions from the chat? Anything you want to know? We're just slowly watching this market melt up to fill that gap. Got a week D period low, so they will likely come back and repair that before they do. Any questions for me from you? Also, can we get some likes up in here? Got 140 people hanging out, but only 74 thumbs up. Mark says, what is the percentage dial on your chart? Yeah, so he's looking at this little thing down here on the bottom left of the Bookmap. This is called Market Pulse. So it's basically measuring the buying pressure versus the selling pressure second by second in the market. So essentially, are there more buyers or sellers? If you see it going green, it means there's more buyers. If you see it going red, it means there's more sellers. Okay. Now, I'm not really watching that at all. I'm not looking at it. But the reason that I have it there is you see these little white lines at the very edge of the range. If it gets more than 90% imbalanced one way or the other, so more than 90% of buyers or more than 90% of sellers, it makes a little noise. It goes like, and that's just another way for me to recognize where there is a potential change in the market. So you'll only get that much buying or selling pressure when you are sweeping the order books. What does sweeping the order books mean? It means there's a bunch of stops. So for example, it will happen up here above 80. There's a bunch of stops right there. People that are shorting right now, they're putting their stops up there. So if the market gets up there, price will go boop, it'll pop right through, and that'll go and it'll make a little noise letting us know that there are buyers up there more than sellers. Well, of course, because all those stops are being taken out. So whenever I hear that noise, I know one of two things is happening in that second, in that moment, as I hear the noise. The market is either running out of buyers because we took out the stops and it's going to turn around and head lower, or taking out those stops might bring in more FOMO buyers and keep the market going higher. So it's just another way to kind of get my attention using sound if I'm distracted, to let me know, hey, look at the chart, Charles. Something's happening. Because, sometimes I get distracted. Topsy says, can you explain what gap you were looking to close? Well, you're going to ruin my beautiful chart. It's basically the low from 4-1 2 days ago, Monday. So we measure gaps as being from the previous day's high or low. So if the market moves higher in the overnight, the gap is to the previous day's high. If the market moves lower in the overnight, the gap is to the previous day's low. So yesterday we had this big gap down. The base of that gap, the place where that gap started, was the low from Monday. That's where we're looking to get to. Now we assume that a lot of these buyers that are going long right now, that's where they're going to take profits. They just want to get to fill that gap. We also know there are likely other sellers that have shorts waiting up here. So we know with a very high probability, as long as we stay above the C period low, that's where the market's going to go. It's going to fill that gap. We don't know what will come next. Will that be it? Will the buyers run out? The market runs out of steam, comes down, gets cessation and goes sideways the rest of the day? Or do new buyers step in and the momentum continues into yesterday or into Monday's range? For that, we will have to wait and see. Ike says, do you go live every day? I do. Monday to Friday. If you're interested, head to piratetraders.io/join. It costs $10 a month to be a member of the brigade. Why not check it out? There's also a link in the description for that. Cog says POC positioning and value area at top. Yes, sir. So we call the point of control, which is this little green letters right here. We call that the fairest price to do business. So by bringing the fairest price to do business up here, it means the market doesn't have to pull back down to bring in buyers. They can step in up here. Having the value area, which represents 70% of the day's trade, pushing up against the high of the day, that's the blue box, pushing up against the high of the day, increases the odds this market can go higher. So those two things in combination, POC pulling up and value area pushing up, tells us we don't need to go down and we're likely to go up. Which is, of course, bullish to see. Thank you, Ike. Appreciate you. Abu says, do I go over or analyze the NQ as much as the ES? No, sir. I do talk about the Q. I always am happy to answer questions and give my insights, but I am an ES trader. So I am laser focused on the ES every day. And that is really what my expertise is in. Each market kind of has its own way of moving. The auction process is the same, obviously. It's always supply and demand. It's always buyers versus sellers. But they each have their own tempo, their own feel, their own range. And so I have chosen to master the ES, as that is what I trade. But feel free to ask questions about the Q at any time, and I'll give whatever insights I have. It just moves too fast for me to trade. My mind goes fucking crazy with with the amount of volatility that the Q gets. So you hear that noise? Click, 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 click. Taking out stops. So that means that's either enough to reverse the market and send us back down, or we'll get more short covering and more FOMO buying. I think the momentum will continue. We're so close to that gap fill. These short-term buyers, they can just taste it. Abu says, I would like to join, but most of my trades are on the NQ. Yeah, I mean, I'm not going to try to pressure you to join, but it's $10, you know? So if anything I say over an entire month of giving you insights every day helps you to even make one single trade where you make $10 a profit, or avoid one losing trade where you would lose $10, it's paid for itself. But I would understand if you wanted to find somebody who's focused on NQ. Kevin says, do you give setups in your membership? No, sir. I do not give live trades. Although technically you can see one on the chart right now if you know what you're looking for. There's a place to know where to go long. There's a place to know where to put your stop. There's a place to know where to take profits. But no, I don't give trade signals. It just, it fucks up my own reading of the market because I get nervous, you know, that other people might lose money. So it just, it messes with my clarity of mind. Debbie B says, Charles is most definitely worth the $10 a month and way more. His narration has saved me from doing stupid things more often than I care to admit. Well, technically, you did just admit it. Alyssa says, but you learn how to think about setups and how to understand the auction process. Yeah, it is my goal to teach you how to fish, not feed you fish. It is my goal to help you learn how to think about the markets so that you can trade all by yourself. Thank you, Cog. Tony says, when I was a young property insurance underwriter, my mentor would never give me answers. He would tell me where to find the answers. Made a lot of sense for both of us since I was responsible. Yeah, it's annoying. When you're trying to learn something, you would really rather somebody just tell you what to do. But if you really want to learn it, you have to figure it out for yourself. Your brain has to solve the riddle. It has to figure it out. It's just the only, I mean, it's any complex skill. That's the way you got to do it. I could show you how to build a table, but until you get your own tools and your own wood and you practice again and again, you're not going to be able to build a nice table. I could teach you how to play basketball, but until you spend years and years and years on the court, shooting the hoops, getting better and better, you're not going to be able to go pro. I could show you how to perform brain surgery, but but until you've cut someone's head open yourself and done it on your own, you just won't understand. You got to learn through experience. Danny says, are you going to discuss possible setups during the workshop? Yes, sir. So during the workshop, I will teach you all my setups. So how I look for entries, where I put my stop, where I put my take profit. And then when they happen in real time, I will mention them as well. I'll say like, oh, this is the one time framing setup. You know what I mean? This is a low risk long. This is a gap fill trade. This is a gap and go trade. Abu says, I hope Charles doesn't get annoyed with me. I won't. Okay. So once again, D period, same as C. The range got tighter and tighter. The tempo got slower and slower. So that is the market telling us it is running out of steam and that this momentum will likely be over soon. But as long as they stay above 76, they can keep the momentum going. And that gap fill is still the highest probability. Bernie says, Europe just closed. Good night, Europe. Sleep well. Okay, so we've reached peak bot shenanigans here. We have had 3 poor highs in a row, all of which have been repaired. But the bots are working awfully hard to stop that gap fill from happening. So the buyers have got to hold this D period low if they want to get that gap fill. Can they hold it? Kevin says, are you trading full time? If you mean, do I trade all day, every day? No, I do not. But if you mean, do I trade for a job? Yes, I do. One thing that happens quite frequently when the bots are in control of the market, which they currently are, is that they will do exactly what they're doing right now. They will just grind and grind and grind in a very, very tight range because it gets day traders emotional. It gets us desperate to get in or out of trades and then makes it easy to squeeze the market one way or to other. So how long will they keep doing this? Making tighter and tighter and tighter ranges? I do not know. But I know whenever it breaks, either the poor high, getting above the D period high, or the D period low, getting cessation, whichever one of those two happens, it will probably create a little pop, a little move. As there will be a lot of traders going short up here and a lot of traders going long down here, and their stops will be tight. So when the market does this, we must just be patient. All right, so it looks like Pal will be speaking at around 12:15, 12:20. So we will watch that here together. Why not? Kevin says, is there any benefits to using Window Trader instead of Sierra? No, not really. I mean, Window Trader has the most bells and whistles. It's the most programmable. You can literally do anything. It's insane how like the types of setups you could create for yourself using this software. But any market profile software is fine, including Sierra Chart. All you really need is the TPOs and the volume profile, right? All you really need to be able to see is where does the market spend the most time and where does the market bring in the most volume. As long as you can see those things, you can read the auction process pretty easily. So there's tons of other features and programmability with Window Trader, but it's not required by any means. Geo says, when you talked about going in when others are fearful or greedy, how do you differentiate that from let the trade come to you concept? So that is part of letting the trade come to you. And I'm talking about you being greedy and fearful as well. It's not just others. It's you too. So for example, let's say the market makes a move up, right? And suddenly there's a change in the market, right? Maybe we were range bound and it was two-sided trade. And now all of a sudden there's a change and, the market moves up. So you think to yourself, okay, now I want to be a buyer. Now I want to go long. If you feel that you have to get long right in that moment, you're probably better off going short. If right in the moment you're like, oh my God, I got to get long, I got to get long, I got to get long, you're probably better off going short, right? So if you have to get in a trade, it would be better to sell than to buy in that moment. But if you want to wait for that trade to come to you, you would have that signal, I want to get long, I want to get long, I want to get long. And instead of smashing the buy button and getting in at market at that moment, you would look at the chart and look for where are the support levels. If the market is going to break higher, where would it come back down to where I could get in with good risk reward? So the conceptual idea of buying fear and selling greed is simply understanding that when a majority of people feel like they have to go long, it is actually probably the worst time to go long. When a majority of people feel like they have to go short, it is probably the worst time to go short. So whether you use that, if you're a scalper, right, whether you use that to instantly enter a trade, right then and there, or you're more of a day trader who uses that as a signal to wait for a pullback into support or into resistance, it is either way a signal to use. Looks like we're having some buffering issues on the YouTube. So if you are finding that the stream is way behind in real time, you may want to refresh. Okay, moment of truth for the buyers. We are here at the D period low. There is a very good chance the market will reverse exactly at this D period low and head back up for the high. Either reverse here, here, or here. One TPO below it. But if it gets 2 TPOs below, that is the end of the momentum. And then we're likely to pull back down and start to squeeze all these buyers. Can they hold it? Thank you, Tony. I agree. Bernie says, huge area of singles below. Yes, sir. But this is momentum. A trend is momentum. And all that matters when the market has momentum is, does it still have momentum? Right? Until we get the signal from the market of cessation, we should assume it can just keep going. The train hasn't stopped yet. And when it does, it'll tell us. We'll get the signal because we'll get, a full point below the D period low. Dun 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 dun. And right on time, an iceberg at the low. Steven says, what is my tick size per letter? 2 ticks per letter. So half a point for each letter that you see. So for me right now, cessation of the trend would be 1 whole point below the D period low, which is 76. It can go half a point below the D period low, and those bots can just reverse it right then and there. And they often do. But if it goes a full point, well, then you start to squeeze the buyers. Mirnal, so for volume profile, it is the same as the market profile. It's window trader. The volume profile is just these sections right here and right here. Danny says, what are the negative numbers? So to be honest with you, I don't really pay attention to this at all. But this little section right here, that is showing the delta between the buyers and sellers. So this is the total number of contracts that have traded within this 30-minute time period. And this is, there were 470 more sellers than buyers at that level. There were 351 more buyers than sellers at that level. But honestly, that's only really helpful if you're like a scalper who's taking very, very fast trades. For my style, it's not really important. Here we go. This is the lowest possible place the market can go and still keep the trend going. If you wanted to get long for a trend, you could do it with half a point of risk right now. Not anymore. There you go. So that is cessation of the trend. That is a signal from the market that the momentum to the upside is likely over. Now, there are some catches to this. Okay. First and foremost, let me just change the banner. There is always a set of laggard buyers that come in after cessation. So the market gets a little dip and then they come in and they start buying again. Okay. So just because we got cessation doesn't mean the market has to instantly crash like a brick. Okay. There's always laggards. There's always that last set of buyers that have been too afraid to buy all day long, and now suddenly they're getting the urge to go long. There is also a poor high, which will act as a magnet, pulling on price. And we still have the value area up against the high of the day, increasing the odds that at some point today, they will poke up and try to get above that high. All of that being said, I do now believe the highest probability for the rest of the day is for the market to go sideways inside the range. At some point in the day, they may poke up and fill the gap, but I do not think it will lead to a new trend to the upside. I think the momentum was created by the news. The FOMO buyers bought as much as they could, and now they've run out, so we're likely to go sideways from here. You combine that with the fact that Powell is about to start speaking in about 20 minutes, the market will be cautious leading up to him speaking, not wanting to make any big crazy moves. So I don't think we're going to completely fill the single prints right now, but maybe after Powell starts to speak. So I suspect we're in for some just sideways choppy mess up here for the next 20 minutes or so. But I will stay and hang out. Why not? And we'll see what happens when Powell starts to speak. And so you say to me, well, Charles, can I go short right now to fill those single prints? There's a pretty decent probability that we will fill those single prints. And my answer would be no. That is not the way I would play it. I would instead watch the market head down. And then whenever it stops filling single prints, whenever it finds support, I would much rather go long to come back up to the fairest price rather than try to short, having no idea how far down it can go and knowing it is probably just going to chop in a tight range until Powell starts to speak. Seven Mile Reach says the Q is filling singles. Let's go take a look. Yeah. Dude, exactly the same for the NQ as the ES. That's crazy. Poor high, value area up against the high of the day. So there will likely be some laggards that will try to step in and get back up to that high. But a lot of single prints below. A lot of single prints below. So same thing. I wouldn't short to fill the single prints. But if I found that they had started to, and then they were finding support, I'd be willing to go long to come back up to the fairest price. On the Q. Yeah, they're identical markets right now. Okay, so we talked about squeezing all those buyers. If you look at the book map, you can hear that da-da-da-da-da that keeps happening. That's those buyers. They're all getting squeezed right now. So I don't know that we will completely backfill the single prints, but we are on a mission to try. The first potential support that is worth taking a look at in my mind is around 64. That is the overnight high, as well as the halfback from today's range. It is important to remember we are below the fairest price to do business. So the sellers actually do not have an edge here. The buyers do. And the further we get from that fairest price, the more likely it's going to need to come back. We also still have the value area up against the high of the day. And a majority of the time, and a majority of the volume was brought in on the upper end of the range. So we got buyers to squeeze, but we will likely get a bounce and come right back up to that fair price. The market is rotational. With that, I'm going to step away for a little bit here. Going to make some lunch. Charlie's getting hungry. So I'm going to make some food, but I will be back to watch Pal in 20 minutes or 10 minutes. Okay, 10 minutes. I guess I'm going to have to eat quick. I'll be back.
fiscal expansion, a lot of asset market volatility, first inflation of magnitude in many years.
All right, they're bringing out Papa Powell. Boo, 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 boo. So expect the market to go sideways while he is talking. If he says anything surprising, which I don't think he will, but if he says anything surprising, that may cause some serious volatility in the market. But otherwise, I expect we're just going to chop sideways. So let's just enjoy the show. Let's hear what Papa Powell has to say.
Out to the stage.
Thank you very much, Dean Levin. It's great to be here today. Thanks to everyone for coming out. It's a pleasure to be here. So I'm going to begin with some comments on the economy and the road ahead for monetary policy before briefly discussing the Federal Reserve's monetary policy independence and then joining Arvind Krishnamurthy for some discussion. So over the past year, inflation has come down significantly, but it's still running above the FOMC's 2% goal. In February, headline inflation was 2.5% over the past 12 months based on PCE index. A year ago, it was 5.2. Core inflation, which excludes the volatile food and energy components, stood at 2.8% in February. A year ago, it was 4.8%. So this is very welcome progress, but as you can see, the job of sustainably restoring 2% inflation is not yet done. Tight monetary policy continues to weigh on demand, particularly in interest-sensitive spending categories. Nonetheless, growth in economic activity and employment was strong in 2023, as real GDP expanded by more than 3%, and 3 million jobs were created, even as inflation fell substantially. This combination of outcomes reflects significant improvements in supply that offset to some extent the effects on demand of tighter financial conditions. The healing of global supply chains helped address pent-up demand for goods, particularly in sectors that had faced considerable shortages, such as autos. In addition, labor supply increased significantly thanks to rising participation among 25 to 54-year-olds, workers in their prime working years, as well as a strong pace of immigration. Recent readings on both job gains and inflation have come in higher than expected. The economy added in an average of 265,000 jobs per month in the 3 years through February, a faster pace than we have seen since last June. And the higher inflation data over January and February were above the low readings in the second half of last year. But these recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path. Labor market rebalancing is evident in many parts of the data, including quits, job openings, surveys of employers and workers, and the continued gradual decline in wage growth. On inflation, it is too soon to say whether the recent readings represent more than just a bump. We do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%. Given the strength of the economy and progress on inflation so far, we have time to let the incoming data guide our decisions on policy. We've held our policy rate at its current level since last July. As shown in the individual projections that the FOMC released just 2 weeks ago, my colleagues and I continue to believe that the policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as we expect, most FOMC participants see it as likely to be appropriate to begin lowering the policy rate at some point this year. Of course, that outlook is still quite uncertain, and we face risks on both sides. Reducing rates too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. But easing policy too late or too little could unduly weaken economic activity and employment. As progress on inflation continues and labor market tightness eases, these risks continue to move into better balance. As conditions evolve, monetary policy is well positioned to confront either of these risks. We are making decisions meeting by meeting, and we'll do everything we can to achieve our maximum employment and price stability goals. And that brings me to my second topic. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. Our success in delivering on these goals matters a great deal to all Americans. To support our pursuit of these goals, Congress granted the Fed a substantial degree of independence in our conduct of monetary policy. Fed policymakers serve long terms that are not synchronized with election cycles. Our decisions are not subject to reversal by other parts of the government other than through legislation. This independence both enables and requires us to make our policy decisions without consideration of short-term political matters. Such independence for a federal agency is and should be rare. In the case of the Fed, independence is essential to our ability to serve the public. The record shows that independent central banks deliver better economic outcomes. We recognize that we need to continually earn this grant of independence, and we do so by carrying out our work with technical competence and objectivity in a transparent and accountable manner, and by sticking to our knitting. By technical competence, I mean that the Fed policymakers use the most up-to-date information and research to deepen our understanding of the ever-evolving economy and to reliably deliver on our assigned goals. We're supported by a highly capable staff. We also draw on the insights and experiences of a wide array of business, academic, community, and labor leaders, as well as others engaged in the economy. And by objective, I mean that our analysis is free from any personal or political bias in service to the public. We will not always get it right. No one does. But our decisions will always reflect our painstaking assessment of what is best for our economy in the medium and longer term, and nothing else. Transparency and accountability are fundamental for any government agency in a democracy, but are especially important for one granted policy independence. The Fed has a special obligation to explain ourselves clearly, to describe what we're doing and why we're doing it. We're always striving to improve this communication, and it is a job that is never complete. But we've come a long way. Before 1994, the FOMC did not even announce monetary policy decisions. Today, we announce those decisions, and we explain the thinking behind them in our post-meeting statement and press conference. We publish detailed minutes of our deliberations and a quarterly summary of economic and policy projections of each FOMC participant. We publish a monetary policy report twice a year, and the chair appears before Congress to present that report and to answer any and all questions that are on the minds of our oversight committee members. In 2020, we completed a year-long public review of our monetary policy framework, and late this year, we will begin just such another review. My colleagues and I explain our views on the economic outlook and monetary policy in speeches like this one and in visits to communities around the country as part of an extensive outreach in which we seek input from individuals and groups throughout society. Transparency is an affirmative and proactive commitment to the public. Lastly, to maintain the public's trust, we also need to avoid mission creep. Our nation faces many challenges, some of which directly or indirectly involve the economy. Fed policymakers are often pressed to take a position on issues that are arguably relevant to the economy but are not within our mandate, such as, for example, particular tax and spending policies, immigration policy, and trade policy. Climate change is another current example. Policies to address climate change are the business of elected officials and those agencies that they have charged with this responsibility. The Fed has received no such charge. We do, however, have a narrow role that relates to our responsibilities as a bank supervisor. The public will expect that the institutions that we regulate and supervise will understand and be able to manage the material risks that they face, which over time are likely to include climate-related financial risks. We will remain alert to the risk that there will be pressure to expand that role over time, but we are not, nor do we seek to be, climate policymakers. In short, doing our job well requires that we respect the limits of our mandate. Thank you. I'll stop there and look forward to our discussion. Thanks.
Thank you very much, Chair Powell, for those remarks and for taking some time to be with us and talk to us today. There's a lot of stuff going on in the world today. I think we have a lot of stuff to talk about, so I'm going to get right into it. Before I get started, I just want to also thank you to the audience for sending questions over. What I've done is I've tried to organize the conversation around two themes. One, we'll start by talking about the macroeconomy, and then you have been shared through a very tumultuous period over the last 5 years, and I want to talk about the leadership challenges around that. So let me just dive right into it, pick up on something you started talking about, which is inflation. 2 years ago, we had inflation readings close to 6-7%. We've come down to 3%. Last Friday, the PCE inflation index, the personal consumption expenditure inflation index, which is something the Fed often speaks about, came in at 2.8%. We've had a conversation about this. There's so many factors that have been play in the economy over the last couple of years. I wonder if you can just spend some time talking to us about what you think are the key factors that have brought inflation down over the last 2 years.
Sure. So I think I'll start with where we think the inflation came from. So what is actually different this time, at the risk of making that statement, is that this inflation wasn't strictly just a question of demand overheating and the Fed coming in and having to suppress demand. That's been the more typical pattern, perhaps on the back of a shock such as an oil price shock and that kind of thing. This episode actually also involved, as everyone will recall, the collapse of the supply side in a lot of ways. So supply chains stopped working. There were shortages of critical things like semiconductors, which turned out you couldn't make cars. I think many of us might not have realized how many semiconductors go into a car. In addition, there was a major labor force shock. So we lost several million people out of the labor market. So we had a very severe labor shortage. So it was a supply side issue, as well as overheated demand from the closing and then reopening of the economy at a time when rates were low and fiscal policy was very supportive of demand. So we had both of those things. And therefore, if those were the causes, what we needed to see was both the unwinding of the pandemic-related distortions to both the supply and demand in the economy, and also the effects of tight monetary policy. So today, what we think we're seeing as inflation has come down sharply over the last year is those two factors working together. And they do work together. We think that tight monetary policy weighing on demand actually gives the supply side a better chance to recover. And 2023, of course, was a year, as I mentioned, of very significant supply-side recovery and expansion.
And what are the factors that you're keeping an eye on, say, over the next few years, maybe the next year or two, that might play out in the inflation picture?
I should also mention inflation expectations, which in our framework and in the thinking of most monetary economists, people think that having the public expect inflation to return to 2% despite it moving up, that's a very important factor in bringing inflation back down. In a sense, if people believe that price setters and wage setters in the economy, if they believe that inflation will be 2%, then that'll actually happen. So as we look ahead, though, one question is how much more juice is there to come out of the supply side recovery? We got a very large increase in population last year, which may have helped with inflation. It certainly helped with output, and it increased the potential output. At the same time, the economy is growing 3.1% last year. Around that, we also had inflation coming down sharply. So there may be more supply side gains to be had. Surveys of businesses still show difficulties in hiring people, different difficulties in getting the inputs that they need for their businesses. So there's some more benefit there. We also think that monetary policy is tight. It's weighing on interest-sensitive spending in the economy. So, for example, durable goods, surveys of consumers will say that it's a tough time to buy durable goods because rates are high. You also see the labor market rebalancing because you can look at demand in the labor market as well as supply, but you see demand reflected in lower job openings, a very small increase in unemployment, in wages moving back down toward more sustainable levels. So we think those two forces that I mentioned will be the ones we'll be looking for. And the thing we'll be looking at, of course, is the incoming data on inflation as those affect the outlook, and the same thing about the labor market. What's happening in the labor market? Does it suggest that the labor market is continuing its progress, and it's made substantial progress, to get back to a sustainable level of wage growth and balance between supply and demand?
Can I just dig into the inflation expectations point you mentioned? An analogy that people drew a couple years ago was to the high inflation episode of the 70s, where we had a high inflation period that then ended up shifting expectations, then through the wage price mechanism ended up leading to a sustained period of high inflation. In the current situation, I guess I have two questions. How concerned are you about maybe inflation getting stuck in the upper twos, around 3? Could that last mile be very hard because inflation expectations getting stuck? And then relatedly, are there things you're looking at to tell you, to signal to you that that is an issue or isn't an issue?
Right. So as I mentioned, inflation expectations we think are an important part of driving actually inflation. And we want them to be at levels that are consistent with 2% inflation over time. Not 3%, but 2%, not 2.5%. The good news is that that's where they are right now and pretty much have been for some time. And we look at surveys of businesses, households, forecasters. We look at other kinds of measures of inflation expectations, model-based and things like that. We also look at market-based. The market is always buying and selling inflation protection, and you can get from that expectation of or assessment of what markets expect. And all of those are pretty consistently saying that the public does believe, and it's a good thing because it's true, that inflation will go back down to 2%. So that's very assuring, but that's partly because of the very strong action that we took and also because of our ongoing commitment to actually return inflation to 2% over time. So, and that is our commitment, by the way. But over time, so I would say it would be a concern if inflation expectations were not to be consistent with the outcome that we seek. But the good news is they're not, and I think our commitment is understood and respected and believed by the public, and that's as it should be.
Let me flip to the other side of the equation. We've had employment, economic activity that remained quite strong. The unemployment rate it's remained below 4% for the last 2 years. And this is during a period in which you've took the funds rate from 0% to 5.3% in about as fast a rate hike cycle as we've seen in history. A year ago, many people were talking about possibility of recession. That hasn't happened. Again, you made some remarks about this, but I wonder if you can just go a little bit more into this. Why hasn't this happened? Why have we achieved what looks like a soft landing, which is inflation coming down, unemployment remaining low? What are the factors that have played out? And then the related question, do we think this will continue to happen over the next year or two?
Yeah, so I guess I've always had the view and always said that because of the unusual origins of this inflation and its differences from other prior episodes, there was a path to getting inflation back down, restoring price stability, getting inflation back down sustainably to 2% without the kind of large job losses and increases in unemployment that have been typical of prior tightening cycles. And the reason, again, was that some part of this was independent of demand. If you have to get all of the inflation reduction gains from suppressing demand, the chances are that will involve that will weigh on employment and economic activity pretty significantly. But here we had the situation for again semiconductors. You couldn't buy a car at the very time when people wanted cars because they were moving to the suburbs, because they didn't want to ride on public transportation because of COVID. At that precise time, the supply of cars went down dramatically because of the shortage. So what happens is the prices went way up. That's how the market clears in our economy. So on the other side of that, though, without respect to demand, once the semiconductor supply comes back, you should come right back down that curve, and you could, in principle, get inflation down significantly without just ignoring demand for a second. So I always thought that was possible, and I would say something like that appears to be happening. Sorry. So then your question is, how did that happen? So more recently. We expected that to happen at the very beginning, and that's why we thought the inflation was transitory, meaning it would go away quickly without much effort from us. That turned out not to be the case. And we thought then that was in 2021. In 2022, We thought the supply side would recover more. It really didn't, and I certainly began to wonder whether that was going to happen. And then it really happened in 2023. Right about the time we were almost ready to give up on supply side recovery, you got this significant increase in labor force participation, accompanied by a significant move up in immigration, and you also got the unwinding of the supply side problem. So what's happening is when that happens, potential output is going up significantly, the economy's productive capacity. So you have a situation where productive capacity is going up even more than actual output. And so the economy actually isn't becoming tighter, which it ordinarily would. It's actually becoming a little looser, and you're seeing inflation come down. Very unusual situation. The pandemic has been, a textbook of unusual, unexpected developments and situations. But that really is the story. And then Arvind, the question is, how much more are we going to get out of the supply side recovery, and how much will fall to demand? And we just don't know the answer to that. We're not going to prematurely assume that there's no more progress to be made on the supply side. Indeed, the evidence is that there probably is more gain to be had there.
You had mentioned immigration has been a big part of the last year or two in terms of the supply side. Can you just expand on that? Is that how important is that relative to supply chain? Where do you see that playing out in the next year or two?
So I need to start by saying that the Fed is not an immigration policymaker, and don't comment on those who do have that assignment or the policies that they make. It's really we're just calling the balls and strikes on the economy as we see them. And so from that standpoint, our economy's been short labor, and probably still is. If you talk to, and we do talk to a lot of business people, it's still difficult to hire for many companies. So we've needed more people. But what happened over the course of last year is, to a much greater extent than had been thought, immigration moved up quite a bit over the last 2 years. And this is typically the Census Bureau does all this estimating. The Congressional Budget Office actually went and took a different path and talked to the people who work at the border and that kind of thing, and got a much higher estimate, which now many groups have gone out to validate. And I would say it's clear there's something there. The numbers are actually higher. And that actually explains what we've been asking ourselves, which is how can the economy have grown over 3% in a year where almost every outside economist was forecasting a recession? An overwhelming majority anyway were forecasting a recession for 2023. Not only did that not happen, we had better than 3% growth. So really a remarkable performance. And some part of that is that there are significantly more people working in the country. But then how does inflation come down? It's because the capacity of the economy has actually moved up perhaps more than the actual output. So it's a bigger economy, but not a tighter one. Really an unexpected and unusual thing. Again, we don't make judgment calls, but that's what we're seeing.
So it's interesting in this discussion we've had about inflation and unemployment. We have talked about real factors, immigration, supply chain healing. That's the stuff that seems to have played out. We haven't really talked about interest rates per se, which is, of course, the primary tool of the Federal Reserve. It looks from the outside like the interest rate sensitivity of the economy in this cycle has been very muted, very different than in the past. There's also, you look at the economy, they look like there's very differential impacts across different parts of the economy. The housing market, people have long-term fixed-rate mortgages, so interest rate pass-through there is very low. Here in Silicon Valley, we have early-stage growth businesses where the cost of capital is affected by the higher rates. And there it looks like we have a much bigger impact. So I wonder if you can speak about the interest rate sensitivity of the economy in this cycle. And then another question, a related question, which is we have differential impact across the economy. How do you think about balancing the impact of interest rate hikes on different sectors?
So I guess the headline for me would be that I do think monetary policy is working and working broadly as expected. I think you can point to sectors of the economy, and you mentioned a couple. So if you're a household that has a low-interest mortgage, you're not feeling the effect of higher mortgage rates. And many companies as well took the opportunity to term out their debt before rates went up. So you have a lot of companies that have longer-term fixed-rate debt at pretty low rates, and they're not as affected by it. That's all true. At the same time, again, if you look at interest-sensitive spending, either in housing or durable goods, you're seeing very significant effects there. And I do think you see the economy rebalancing. So I think it's not right and maybe too soon to conclude that there's some significant disconnect there in terms of monetary policy transmission. But it still leaves the question of how the economy can have grown over 3% during a year in which.
Okay, so the market has worked its way back up above the fairest price to do business. Got a little bit of resistance here at the G period high. So I can't predict whether we're going to poke up and fill the gap right now, but I will just say if we do poke up and fill the gap, I don't think they're going to get much further continuation. I think it'll run out of steam and come right back down to the fairest price. So the market remains rotational. Act accordingly.
It's not that the economy is not responsive to rates. It's that we've had this outside force that is temporarily affecting that.
So if I benchmark Fed policy right now, we have rates at 5.3%. Inflation is running a little bit under 3%. That's like a 2.5% real interest rate. That's really the real cost of borrowing. Compare this to pre-pandemic. We had real rates of close to 0, maybe 0.5%. Sometimes negative. So we've gone from a very low rate environment to a very high rate environment. Policy looks tight right now. Another benchmark, I don't know if my colleague John Taylor is here, but the Taylor rule is a typical benchmark we use for thinking about central bank policy. And by the Taylor rule, policy rates right now should be around 4. So policy does look quite restrictive right now. And I think in talking about where policy is right now, you've said that the risks are balanced. Why continue to have tight policy in an environment in which the risks are balanced?
So we do think that policy is restrictive. We think it's doing its job. I would go back to what I said in my remarks to start, which is we think the risks are two-sided. So there's a risk of if you cut too soon, the risk is that the progress on inflation will stop, or that even it will reverse. And we've seen that in some historical, particularly in the 70s. We don't think that's what's happening here at all, but that's a risk that we have to manage. The other risk is that we wait too long or move too slowly. Once we do move, and in that case you have weakening in the labor market and economic output. So we're trying to steer between those two risks. Obviously, we're trying to be in the middle and get the timing right. It's very challenging. There is no risk-free path, but and I think we're in a position to address the economy moving in either of those directions. So the risk, though, of moving too soon really is that the economy, really does, the inflation does move up, and then it really would be quite disruptive if we were to have to then come back in. We will do what we have to do to get inflation down to 2%, but again, it's about balancing those risks. It's never the case that you can confidently look at the baseline and say, this is what we're going to do. It's always about having a baseline understanding, but then knowing what the risks are and having the committee be in a position to be able to address those should they materialize. And I think we're very much in that position now.
Maybe I can just follow up on that. So I'm going to ask a question about, is there a signal or a data point that you're paying particular attention to over the next year? And I'm going to ask it this way. So if you had a crystal ball that you knew could perfectly answer one question about the next 12 months, what question would you ask it? What's the thing you really want to know?
Sorry, there's no one thing. It really is. We have a dual mandate. You're asking me to be single-minded about the dual mandate.
No, just kind of a data point that you think will guide you.
Can't do that. No, I mean, we have to, I would say this. In our framework, the two goals, price stability and maximum employment, are equal under the law. But our framework literally says that if you're very far from achieving one of the goals and the other one is pretty much at goal or even better than goal, then you focus on the one that's far from goal. This is obvious, right? So, and that's what we did after inflation came up in March of 21, and then we really had a very tight focus, and you heard us talking about, getting inflation under control. But as inflation has come down, the two things are moving back into balance. And we're not a single mandate bank. The key thing I'll end with, though, is price stability it gives us the ability to achieve both goals. If we don't have price stability, then we're not going to have these long periods of tight labor markets, which benefit everyone. What we saw in the 10-year, 8-month expansion that ended with the pandemic was, for the last 2 or 3 years, the people at the lower end of the income spectrum were getting the largest wage increases. And you saw the gaps between black and white unemployment go to historic lows. So a tight labor market over a long period of time does enormous social good. And that's what we all want to do, is we want to get back to that. For that, you need price stability. But so the two of them actually are quite complementary.
I'm going to shift from just talking about the near term to the thinking about the longer term for the U.S. economy. We've had a pretty big shift in growth expectations for long-run growth. This comes out from the Fed's own projections as well as from economic forecasters' projections. For 15 years ago, long-term growth forecasts were 2.8%, 3%. Pre-pandemic, they've been below 2. That's kind of where they've been for long-term growth forecasts. That's where your own forecasts have been. Why do you think that is? Why long-term growth at 2%? We're sitting in Silicon Valley. AI is all the buzz here. We've had high growth over the last few years. Is 2 a reasonable number? Is it possible we could go back to the 2.83% that we had in the early 2000s?
So let me start by saying that sort of every bit of the economy is difficult to forecast. There isn't one that's more difficult to forecast than productivity, for example, which is one of the key elements of longer-term growth. So it's very, very, very uncertain. I mean, basically, what longer-term growth is a function of growth in hours worked and of output per hour. And hours worked is really a function of demographics and more than anything else. And productivity, output per hour, is highly unpredictable. So I think people lowered their longer-run growth expectations to around, I guess, 1.8% as the median, something below 2%. That's given what had been our very low population growth and expectations that productivity might be 1.5%, 1%, 1.5% kind of thing, productivity growth in output per hour. That's a pretty good place to be. We've had higher productivity than that recently, and the question is it going to be a sustained thing? Are we going to enter into a new period of higher productivity? That would be great. It is productivity growth that lifts, all boats, generation upon generation. And so people argue AI can be that effect. Some people are arguing that there were a lot of business starts at the beginning of the pandemic and during the pandemic, as Americans went out and started businesses at that time, and also that you've seen a lot of change in the labor force. So people moving, quitting, going to better jobs that might be better suited to their skills. But all of those things, they could become a longer run productivity increase or not. Those might just be the things that we need to get 1.5% productivity. And it is unknowable. And particularly with AI, the range of potential outcomes, it should increase productivity. Everyone sees that. But that's not what we're seeing in the numbers now. It's too soon for AI to be affecting, I think, the productivity numbers. But the logic of it is that it could actually increase productivity. And then the question will be, what does it do to labor? Is it going to replace labor or augment labor or both? And if so, in what proportion? So hard to say about longer run growth, but of course, it would be great if that were the case.
And then just to follow up, we talked about this before. Do you feel like you need to take a stand on this in policy making at current?
No. I mean, so our focus, the things that are really important to the U.S. economy over time are productivity, immigration, even trade policy, the things that we're doing, industrial policy that is now a thing. Those are important to the longer run growth and economic well-being of Americans. And what we do is we try to move the economy towards stable prices and maximum employment through the business cycle. That's what we can do with business rate, with monetary policy. We are also a crisis responder. We're a really important crisis responder. responder. We can get there quickly. We have great tools for it. So that's a key thing that we do. We also regulate and supervise the banks, and it's important, and we look after financial stability. So all those are very important things, but they're not things that affect the longer run potential output of the United States. So honestly, though, so the question of what will be the equilibrium interest rate, the neutral interest rate going forward, doesn't really matter for policy today. We're really asking about once the pandemic is well and truly behind us and we're well into the AI investment boom and the effects of AI, what will that look like? And it doesn't really matter that much for getting inflation down to 2% while keeping the economy growing and the labor market strong.
Can I shift tax and talk about some of the challenges of leading the Fed through the last 5 years? So, just in our discussion, and it's clear from looking at the world, you've had so many different shocks. The economy has behaved in so much unusual ways over the last few years. You were appointed Fed chair in 2018. I remember pre-pandemic, the dominant concern of the Fed was low inflation, not high inflation. It was having inflation below target, below the 2% target. COVID happened. We've gone in a completely different direction. So can you just speak about the challenges of taking an organization that was focused on one thing to focusing on something completely different?
Yes, it's certainly been a turbulent time, I will say, to Dean Levin's points. It's been really a lot of things and things that weren't expected. For 20 plus years around the world, economies suffered from lower interest rates, lower inflation, slow growth, low productivity, bad demographics, and a lot of monetary economists were working on how do you make your tools work at a time when you're going to be bounded by zero, and you won't be able to cut and support the economy. So this was a big thing, and then the inflation that came, it really arrived in the first quarter of 2021 was a surprise to most people, and again the macroeconomists generally thought that it would go away over time. Not everyone. There were some concerns expressed, and ultimately it is coming down significantly. So that was we had to pivot on that, and we did. When it became clear, really in the fall of 2021, it became clear through the labor market data, the inflation data, the growth data, that the economy was not moving back toward price stability. And we pivoted, and when we pivoted, we really moved. So because that was the right thing to do. So the good news about monetary policy is it can move quickly. The emergency tools we have, as I mentioned, are agile compared to other government policies, and they have a significant effect on the economy. So I think we've gotten to what is, knock on wood, a pretty good place. We're using our tools now to try to bring inflation down the rest of the way to 2% while keeping the economy strong and the labor market strong as well.
I mean, the other side of this tumultuous period that we've been through is the external pressure from the Fed, from outside over where to set interest rates. And you have faced this pressure over the last 6 years, including from the former president. So how do you navigate the decision-making of the Fed in the larger scheme of pressures coming in from the outside?
So the thing is, internally we have peace of mind on this because everybody who works at the Fed knows that we're going to do what we're going to do, and we're going to do it for economic reasons, and that's it, as I mentioned in my remarks. And I mean, I think you can go back and look. Anybody can read the verbatim transcripts of the things that we discuss during. It doesn't matter what the election calendar is saying. Whatever's happening in the economy, those are the decisions. We make decisions based on the analysis that I described in my remarks. So I think we know that. So it becomes, but it's a communication issue that people need to understand that that's what we do. It's always what we do. If you look at the modern historical record, you'll see that the Fed has been prepared to move or not move and do what it thinks is the right thing for the economy in the medium and longer term without regard to kind of outside considerations. And it's important to just have people know that, which is why I brought it up. I don't have concerns that it's going to be a problem for us because we're going to do what the right thing is for the economy over time, and my colleagues and I are tightly focused on that.
Maybe you can just say a little bit more about that. I mean, you're praised by many people in your your ability to build consensus. You've served in different White House administrations with different political ideologies. How do you do that in practice? Do you have any advice for all of us? And
so it boils down to two things. One is, we have a specific mandate. Stick to that mandate. Focus on that mandate, and don't be dragged into partisan political fights around. I mean, when I testify, people are always trying to get me and my colleagues to support their perspective on, fiscal issues or immigration issues, and they think of an economic hook, and they try to. But we just don't do that. That's part of it. The other part of it just is, I spend a lot of time in our system of government, oversight comes through Congress. In a parliamentary system, it's through the elected government, but because that's the same people who are in the parliament. But for us, it's not the administration that has legal oversight responsibility. It's the Congress, the House and the Senate, and particularly the two oversight committees, one in the House, one in the Senate. And so my colleagues and I spend a lot of time, and we don't go up there to blast talking points at people. We want to hear what they're thinking, and we want to listen carefully and respectfully and tell them what we're thinking. And I think people appreciate that. That's the thing. Same thing internally. I think when you listen respectfully and understand what people are saying and try to, think about how to incorporate that thinking into what you're doing, for most people, most of the time, that's going to be enough. And so they can go along with things that they don't 100% support, but they feel like they were heard, or they're not going to, maybe criticize quite as harshly as they would, because they realize that you're doing this in good faith, to the absolute best of your ability, and based on the actual facts and what we know about the ever-evolving economy.
And can I just ask about how your own background has helped in this process? So you are a person who has shifted between the public and the private sector over the course of your career. And you're a lawyer by training. You don't have an economics PhD. You're running an organization which is mostly a PhD, or many PhD economists. So can you just speak about how your background has helped you navigate this?
Sure. So when I graduated from college, I had no plan other than this idea that I liked what I saw of the careers of people like George Shultz or Cyrus Vance, for example. And that the idea was these are people who had a mainly private sector career, but served in the government at intervals and were able to do public service. And I grew up in Washington, D.C. My family was not involved in any of this, really. But this is what I observed, and I thought I would like to do that. And by some miracle, that's kind of what happened. It wasn't careful planning. So I always wanted to do public service, and I wound up doing that. I served as an aide on the Hill. I was at a law, all these different things that I've done. So that's how that happened.
And then I'll ask one last question for this. Do you have any advice for the students in this room whose interests are to move between public and private sector?
So I think that's a great plan for people. People have different tolerance levels for volatility. So, I quit the law and went into investment banking, quit investment banking and went into private equity, quit private equity and went into public service. So if you're willing to tolerate volatility and steep learning curves, then if you're that person, then that's a great way to go. The other thing I'll say, though, is I have really found that when I was a partner at a private equity firm, I asked the head of the investment area, what do you look for? It's all about picking good CEOs and good business models. What do you look for in a good CEO? And the answer was, there's no one model. And that's really important. I have seen very different people be successful in leadership roles. Very, very different people. And it's in, I don't know if it's in every person, but it's in a lot of people to find your own way to lead. And you don't have to be one way or another. I can think of one person at the Fed she had a way of being a very soft talker, and by the end of the meeting, everyone was leaving there thinking, how do I do what she said? It's like, I want to do that. It's in everybody, and you should have the self-confidence. What I experienced when I first had to lead things was complete lack of self-confidence. Oh my God, I'm not ready to do this. And I think that's very common for people. I think people get more coaching now, but I would just say be confident in your own abilities to lead and take things on and take risk, because that will that's, if I could say that to something to my younger self, I think that would be it.
Jay, we're running on time here, and there's lots more stuff we could talk about, but I'm mindful of time. So let me just first of all thank you on behalf of Stanford for being here, engaging us in this conversation. It's been very stimulating. I know I learned a lot, and I hope we all learned a lot. And again, so thanks very much for your time.
Thanks, Audrey. Thank you. Thank you.
Alrighty then, that was actually a good talk. You know, normally he just kind of says the same stuff over and over again because he's normally being interviewed either by Congress, which are the worst question askers, or the reporters who just always ask the same thing. It was kind of nice to get a different perspective. But anyway, I'm going to call it quits here on the live stream for today. So let me give you some concepts to carry forward throughout the rest of the day. I once again will just repeat, I do think at some point today, they're going to poke up and fill that gap. My reason for believing that that will take place is one of two things. First and foremost, we have a poor high, which slightly increases the odds that at some point today they will try to get above that high. If they do, it's just a hop, skip, and a jump to fill the gap. So that is one reason why I believe that it is possible. Another is the fact that the fairest price to do business is all the way up here near the high of the day, and the value area, whilst it is getting tighter and tighter, is still up here in the upper end of the range. So all of those things just tell us the market doesn't need a bigger pullback. And so it just makes more sense to try another poke to the upside. And then the last thing that I am watching, as we discussed earlier this morning, the more time and the more volume that we bring in above the balance area high, the more likely the market in the days that follow will make a move towards the upper end of balance. So if the bulls want that to happen, if they want the market to make a move up, they will want to spend as much time and bring in as much volume as they can above 74. The best way to do that would be to poke back up above the high and bring in a bunch of new FOMO buying. Now, that being said, I don't necessarily think it's going to run away to the moon here today. I suspect they'll fill the gap, run out of steam, come back down, and then we just go sideways. But I do think at some point they will try to poke up above that high. Otherwise, the market is rotational. Assume the rotation will continue. Monitor the fairest price to do business, the time point of control. Also keep a close eye on the VWAP. Both of those will become levels that the market will want to touch again and again as long as the market remains rotational. Okay. As far as how to carry this forward into tomorrow and the next day, you know, again, it's hard to make a call now. We still got half a day of trading ahead of us. But if we open below 74 tomorrow, that will likely lead to further downside continuation. And if we open above, it will likely lead to further upside continuation. This is now a look below and fail of that channel, which again, we discussed. What happened the last time we had a day like this, where the market looked below the channel and pulled back up, slingshot straight up to the opposite end. So pretty much that balance area low, that channel trend line, that is going to be, you know, what matters when we close at the end of the day today. Close above it, and it is bullish for continuation higher, just like it has been in the past. With that, I will say goodbye. Wish you all the best of luck. If you are not a member of the brigade, you might consider joining so you can hang out with us every day. If you have no clue what I'm talking about, and I'm throwing out all these references, I'm saying it's a value area. I'm saying it's a poor high. I'm saying we got fairest price to do business. I'm saying and you have no clue what I'm talking about. You might consider checking out the Market the Mastery of Markets and Minds workshop, available at marketsandmind.com. I'll be doing it next month. It'll be 4 hours a day for 2 weeks straight. If you can't join us live, you can always watch the replay videos afterward for up to a year. And I will give you all the information you need to understand how to read the two-way auction process and how to conduct yourself as a professional trader. How to develop a winning edge, how to monitor and change with the ever-changing markets, how to manage your own self-discipline, and you might even make some friends along the way. So I hope you give it some consideration. With that, I will say goodbye and wish you all the best of luck.